Quast with Market Structure Edge. Along with me is, as usual, my sidekick, Brian Wilson, market strategist. And it's Brian's turn to go first, which is good news for me because I need to pull some data up. So, Brian, over to you.
Thank you. Good to see you all. Hope you're having a wonderful summer. I'll give you an example of Colorado summer here. A couple days ago, got done with work, and it's about an hour to get up into the mountains. So I grabbed my daughter. We went up in the mountains. We did a little bit of stream fishing, and it was 90 degrees down here, and it was 60 degrees up there. So about a 30-degree difference in temperature, and then it proceeded to rain on us. So we got very wet and very cold, but thankfully we had brought a change of clothes. But just part of the summer, part of getting out. So it was nice to spend time with my daughter. I've got about 4 or 5 topics today. I guess 4 topics, and then kind of a look ahead. A couple of the topics will be repeats for those that are here every week, but it's good to remind ourselves of what's happening in the market. And we'll start off with our broad market look. Actually, let me reverse this. We'll start off with a big tech look. This is just a worksheet that I keep, but it gives a pretty good idea. What you see in front of you is basically the SPY from yesterday. And if you can see down here at the bottom, it's about 35%. If you look at kind of those big tech components, Broadcom's in there as well. But let's call it a third of the S&P 500 is the big tech components at any given point in time. Most of you are aware of that. And if I could give you one pointer today, it's perhaps just, if you want to do anything with the data and you're not sure what to do, just watch big tech. Once again, it's about a third of daily trading. If you watch the trends happening in big tech, and we talked about this last week, I thought maybe we would be okay coming through expirations because big tech was okay. It never went below neutral, and that indeed was the case. But just a reminder, as big tech goes, so goes the market in general terms. And let me give you an example of what we've seen here over the course of the last 6 months or so. I'll take this back to year to date. So beginning of the year, in terms of big tech sentiment, up until mid-February, and you can see the market was, it was about a 4% appreciation for the market through this stretch. Big tech sentiment averaged 5.15. That's about what you would expect for that type of performance in the market. As we had this downturn in the market, very predictive, big tech sentiment 3.6. So big tech was very, very weak, and the market just couldn't recover because big tech wasn't there to support the market. As we have had this run from April going forward, big tech sentiment has averaged 6.82. So very, very hot sentiment from a big tech perspective, supporting this run that we have been on. And if we look at where big tech is right now, and it's kind of part of our look ahead, we would say probably expect more of the same. We look at big tech sentiment right now, it's 7.5. So it's kind of a continuation of what we have been seeing. I mentioned this note earlier, or I mentioned this saying. It's just an informal saying, but as I was looking at the market this morning and thinking about what to write, the saying that came to mind was, "If it ain't broke, don't fix it." And what I mean by that is, if you look at what's been occurring, especially during the last 2 expiration cycles, these cycles have been exactly what normally occurs in the market. The market gets above the red line, it becomes overbought or stretched, and market returns tend to either move lower or you just get a slowdown in appreciation. The average is about 50 to 60 basis points from red line to red line, and the normal time above the red line is about nine trading days. That's exactly what happened here. Market moved down just a little bit. I think it was down 1%. And this stretch through here, market was up, I believe, 60 basis points. But it was doing exactly what normally occurs. Now, what's been occurring coming out of these expiration cycles? Basically, the same strategies keep getting employed. We take a break going through expirations, everyone jumps back into leverage, and the market continues higher. We take a break coming through expirations. It looks like everyone's jumping back into leverage, market goes higher. Even back here, it was the same thing. Took a break coming through expirations, market went higher. So right now, it's not broken. So everyone just continues to employ the same strategies. And I think, once again, going back to big tech, if we get big tech that ever breaks down below neutral, that'll be a pretty good signal, I think, to us that maybe some of these strategies are no longer working. I did want to remind you about context in the market, and we mention it during our notes every time. We try to anyway. Let's just go to Edge for a moment. And if you want to look it up yourself, you can go right here under resources and then expirations calendar. That will give you a good look about what's coming up, what to expect. As I mentioned, we do try to mention it in the notes. But if we look at July, we had the July expirations period. We hit, you can see this week is wide open in terms of activity. But one area to watch out for that Monday, the 21st, was the focus was going to shift to the new series of options, to the August series of options. We had a couple of names in the, go back here for a second, sorry. We had a couple of names and I have it up here, just go right there to Rocket Labs. Couple of names in our momentum portfolio that were, just lights out coming through expirations, but we hit a potential inflection point. So look at what Rocket Labs was doing. It had gone from all the way down to 34. We come into expirations, conclusion of expirations. It was all the way up at 51. Now recognize this is a point in time where strategies and tactics can change afterwards. It's why context is important. We look at what happens on Monday. We go from 51, down to 47. So we, have a pretty significant hiccup. And this was happening across the board with Monday's trading. If you look at Archer Aviation, that was another example. I could probably pull up 2 or 3 more. But look at the appreciation here, moving from 10 all the way up to 13 at expirations, and look at what happened afterwards, all the way down to 1185. So just a reminder that context is, very, very important in the market. And especially if you're trading in some of those names, like these momentum names, they're momentum for a reason. And if you look at some of the intraday volatility in some of these names, at times, they can be pretty significant. Let's sort it by volatility. So today's names, look at that, 15% volatility, 9%, 8%, 8%. So you get the idea that at times these names can be very volatile. And just a reminder, if you're trading in these names, to just be aware of that, that you have the potential, that it could be down that much in a given trading day. It's usually not the case, but that potential is there. One other reminder in terms of context is to watch out for earnings. We're moving smack dab into the heart of earnings season. Well, the heart of earnings season is probably in about a week and a half, but we're starting to move into it right now. It will just continue over the next 3 to 4 weeks. I did mention passive money this morning in the note, and I wanted to show you a couple of things. in terms of passive money. So this is one of our modern IR reports. I try to share some of this information with you when it's applicable. But what I wanted to show you was what's happening on the passive investment side. So take a look at the trends over time, 200-day, 50, 20, and 5, and look at how passive money is just increasing over time. We continue to get the ETF creation redemption process that is just continuing to lift the markets. Once again, if it ain't broke, don't fix it. It's not broke right now, so the process continues. But for comparison, look at the Russell 3000. That's exactly the opposite. We had greater influence on a 50-day period, but that influence is actually moving the other direction. Once again, the money tends to flow to the big guys. The smaller guys, as a general rule, don't tend to get as much of that money. Look at the SPY for an even starker comparison here. So once again, this is our modern IR report. I mentioned this in this morning's note. Take a look at these trends. 20%, 21, 24, all the way up to 28% average during the course of the last 5 days. Just an extreme outlier right now. You can see what's happening is passive money is basically stealing order flow from the machines. But just huge passive investment influence. And with that, I will stop. I think Tim has some information on ETFs as it pertains to passive money that he was going to share.
Hey, thanks, Brian.
Yep.
And behind the scenes, Excel crashed on me while this was occurring, but fortunately, I think I've got it back. So it's a par for the course. Okay, so I talked about this a fair amount last time. It's just it's something to keep in mind. It's why the market does what it does. I highlighted how much money has shifted to ETFs, and this is another way to think about this. So this document, which is kind of small on your screen, and you don't have to bog down in the details. I'm just going to look at these, the top few here. It's Vetify data, and it shows there are all kinds of pretty interesting data here on how many ETFs are being created, and I've mentioned those last time. There are basically 4,000 ETFs, and a lot of these are the conversion of mutual funds to ETFs. Vanguard actually patented a process, and that patent has now expired, to issue a class of shares that would trade as an ETF on the same underlying index fund. And with that patent having expired, other people can do that. And there has been a mad rush to do so. But if you just look at BlackRock and Vanguard, this is in the last 3 months alone. BlackRock and Vanguard have had a combined almost $130 billion flow into ETFs. Well, where's it going to go? Right? It's got to go. It's primarily running on models, even active ETFs. There are more active ETFs being created in 2025 than passive ones. But that doesn't mean they're stock picking. What it means, and look, this is what we have discussions about doing too, about creating ETFs using our underlying intellectual property. And we're having those discussions. It's a crowded market. I'm a little concerned about that there are so many of them out there. But the active ETFs are just constructing a basket every day so that they don't have to license IP. And while this isn't all equities, it tells you that a lot of money has to be deployed, and that's the effect that we see in the market. I thought, Brian, your note was good today, and this was a very good discussion. Our own, I like to trade volatility and inflection points, and you don't know how those things are going to go. But the data have been just spot on, really. There is no, we spend a lot of time going back and looking because we all have confirmation biases and subjectivity. I went back and looked at what had happened historically, particularly during times of momentum when the market tops into options expirations. And as Brian pointed out, it did exactly the same thing. There is no variation in the data as much as it seems like there is. The only anomaly, which is one of the things I wanted to talk about, and I think Brian did a very good job of casting this characterization upon the market. He said, it's behaving a lot like a pandemic market, um, and it has. It's been very compressed. Everything that happened over a roughly 18-month period of time from 2020 to latter 2021 has occurred in a 3-month period of time here, including meme stocks, as you've probably noticed. There are, whatever handful of them that have manifested all of the characteristics of meme stocks, and we can see that data. We can see who's responsible for it. So if you take Krispy Kreme, DNUT, or GoPro, GPRO, or Woof, Petco, WOOF, and there's another one too that you will know. And we look at the patterns in those stocks. It is exactly what occurred during the AMC, GameStop, etc. meme stock period. Bed Bath and Beyond, gone. Completely gone. So does that mean the whole cycle will be compressed? I don't know, but it's possible, isn't it? So we'll see. I have a couple more data items I want to show you, and I'm going to stop sharing because I got to pull these up. Bear with me 1 second here. Germane to this topic, how the market behaves in really reasonably predictive ways. And one of those is the components of the momentum and low volatility portfolios. So bear with me a second here. I want to show you something. I asked for one of the engineers to get me a complete set, and he sent a note and said, I don't have it for you yet, with apologies. And I said, that's fine. So I have a data sample here, and it's not the complete data set, but it will make the point. I'm waiting for it to open.
I'll make one point while you're doing that, Tim. Just
Yeah,
as an
please.
FYI, if you guys are ever looking at meme stocks and kind of taking a peek at them, they tend to be dominated by fast traders. That tends to be the dominant characteristics. If you think about retail order flow, that's going to be coming into those names. Fast traders have bought out that retail order flow, so it's going to show up as fast trading activity. Once again, you get the fast traders that have bought out that retail order flow, plus the machines are just going to detect all that and be front running all of that activity. So if you ever are just curious and you're looking at some of them, that tends to be the principal behavior.
Yeah, and we've talked about how the mechanism, the market's Achilles heel, which by the way makes it very hard to short the market. You have to, if you're going to do that, it has to be at and I do, but at inflection points, because and we've talked about this many times, so apologies for the redundancy for the you veterans, but it's Reg SHO Rule 201 data that we track called short volume, and Reg SHO Rule 203b2, very weedy jargoned market structure data, permits market makers, like Virtu. I wrote about this. Virtu, Jane Street, Two Sigma, Hudson River Trading is getting into this business too, and Citadel are the principal consumers of retail order flow. You trade commission free. It's because your broker is selling that order flow to one of these firms, and that those firms buy it and execute it. I've mentioned before, I know Doug Sifu, the CEO of Virtu, and talked to him about this numerous times. He said, well, we're taking risk. Yeah, kind of. But they buy the order flow because they intend to sell it at a better price, and they're very good at it. I mean, go look at Virtu's financials. On trading, they make $500 million a quarter doing it. It's pretty good business. And so they'll fill orders. They'll create stock to fill orders, and stocks go up 100%. I mean, how else would it happen, right? If you want to buy a stock and no one wants to sell it, how could your trade get filled? Stop to think about that for a moment. How is it possible for something to be available all the time? Well, it's not. And in context of physics, it's not possible. In context of market rules, it is, because market makers create stock. They're going to have to square the books. It's what we've talked about, that the high levels of short volume are really interesting to me. How is that occurring? Well, I think, again, that it's a function of the create redeem mechanism for ETFs that is happening so frequently. There's a lot of borrowing. There's a lot of cash substitution occurring. I'm confident of that. I traded notes this morning with the DTCC's head of data products. They're responsible for all that stuff. So anyway, just things that you have to keep in mind. So what this messy chart is showing is a chunk of data. It happens to be the only chunk of data I had. This is what I wanted. So it runs from April 17 to sometime in 2024, and it just it's tracking the number of components in the low volatility and momentum portfolios. What's the average, and how does that comport with how the market behaves? So if you compare broad sentiment, that orange bar, with the momentum components, which are the orange one, and the low volatility one, which is blue, what is fascinating is that the number of momentum components tends to comport with a strong market. It's not surprising, is it? It's like confirmation. If there are a lot of components in the momentum portfolio, unless it's an inflection point, you probably want to be trading that. And here's a fascinating fact. While you can't see it with the eye, a correlation calculation of demand versus low volatility is inversely correlated. And we see this in our model portfolios, that generally low volatility performs very well when the market performs poorly. Well, there you go, right? So that at inflection points, or if the market is doing poorly, trade low volatility. Money will concentrate into things that are less volatile and more stable, spending time at 5, and you can make money. When the market is a momentum market, as it has been, you take what the market gives, and there will be turning points, no doubt. Okay, there's one last thing I want to share with you, and we will come around to what's next. I've spent a lot of time on these model portfolios, and we're trying to build focused ones that, could you just have a retail style, meaning we aren't, most of us aren't institutions. Some of you are, have a lot of money to deploy. But generally, you're not wanting to buy like 35 components. And it's interesting to look at the ETFs that are coming out. A lot of them, that's about where they are. It's not 200 components, because you can't find 200 components. But what about 5? I mean, how about, what about a portfolio of 5? The risk of 5 is it's a concentrated or focused portfolio. The good news is that you can escape the deteriorating returns that come with a large portfolio. The larger your portfolio, the greater the probability it migrates to the mean, right? It's the law of large numbers. It's the problem for hedge funds. The more money you have under management, the harder it becomes to deliver returns. And so I want to show you one additional thing, which I think for a period of time, if you're interested, if you have to be a subscriber, but I would be comfortable sharing this with you. We don't give advice. We are a data analytics firm. That's what we are. We produce data. We run a lot of models. We understand how the market works. And the aim here is to use that information to improve returns. So with that caveat, let me pull this thing up really quickly. And this is the last thing, as I said. So this is what we call the edge focused momentum portfolio. So it has very similar criteria to what are on the Edge platform. We're using the same criteria. We might use a different mix of them. But we have run this data extensive, well, run all kinds of data. We can clearly deliver 5-year performance by changing the basket that
Tim, can you
sharply.
share your
Yeah,
screen, please?
it's still loading.
Oh, okay.
I've done it for a reason.
Yeah.
I keep getting issues with this. There we go. Now it finally loaded properly. Okay, now I'll share. But the data work. Yeah, you can if you change your basket based on performance, the data just work really, really well. So this is a year-to-date performance through yesterday for the focus momentum portfolio versus the S&P 500. So I mean, it's up. It has periods where it doesn't, but it's up 29%. I'll show you the the portfolio, and it didn't even go negative in April. I mean, it gave back a lot of gains. It was up over 20%, and it drops down to 3% or thereabouts. But it's pretty impressive performance. And it's a small handful of stocks. I'll take you to the top, and this is what we run models for. We just put criteria in, and it runs the data. And so we run it year to date with one new day every day, and it takes 45 seconds, something like that. So going to the top, the initial, we're going to own the same thing as everybody else, right? There are only so many stocks and stocks that fit the criteria. So what matters is when you come and go. So you start out with the portfolio, and every day it's going to say, well, get rid of this and add this. And the criteria that we have for it, they're the 5 components, minimum of 2. We're not going to change it all the time, but mathematically, it's just going to find stuff for you every day and create a portfolio, right? And help you balance it. In this particular case, we're running it with $100,000. You could run it with 10, right? And it's just going to allocate very equally. So equal allocation. It'll calculate the number of shares that represents, and then it tabulates returns, of course. And so as of today, this portfolio includes Arista, Lee, that probably didn't help us. Certainly what's this? GE Verona, I think, and Citi, and then there's the portfolio. It's up 29.4% year to date. So not going to work all the time, and things change. We ran a take 2 portfolio, take 2%. It's exactly what we say when you're trading short term. And we took out the short volume requirement. I've mentioned this to you before. And that portfolio performed brilliantly during April. Hasn't performed brilliantly since, interestingly. A combined portfolio that's looking for both momentum and low volatility, combining things from both portfolios, is up about close to 10% year to date, but that's not much better than the market. A fives portfolio where it's just fives, interestingly, even though that tends to do better when the market does poorly, is actually up a little better than that. They're up both about 10%. So those are, they're model portfolios, and it's things that we work on that we think could be helpful. So I think, as I said, I will send a note about it. But if you're interested, we'll share that. It can be interesting to track, and you can vet and validate the data. But the nice thing about it is that you get the combination, right? You can do daily trading ideas. If you don't want to be watching screens, all you have to do is once a day rebalance your portfolio, and that's again, doesn't work all the time. It is nice, right, Brad? I mean, I don't know how that's going to come out. It's interesting too that if you increase that portfolio to 30 components, performance deteriorates. But it very consistently at 5, it delivers. I'd like to do that, get that all figured out with the different sets. Can we do it with low volatility? Can we do it here? Can we do it here? And it's almost like if you, under different conditions, you would shift baskets or change horses. And we run them together. We're running a comparative performance that looks at standard deviation and performance of each of those versus the S&P 500. And when one starts to deteriorate, you shift horses, switch to the other horse. And I think that can make good sense. So how many trades have I made year to? Whoa, I trade up quite a lot. So it's a lot. I'd have to go run a report. How about you in that model? Um, about a month's worth. So I don't know, like 20, probably something like that. But I'm certainly going to do it more, right? And I model it first, and then if can you direct some of your portfolio to this thing, some to this, and some to this, and I think that can make good sense.
Tim, what's your timing for those names in the model portfolio? Do you buy them at the open? Do you sell at the end of the day?
And we ran the math on that too. I'm going to tend to follow what I always do, which is I like to buy late in the day and get the reference price, Yeah. And then if whatever rebalances, I rebalance it right off the bat. I do. Just so I don't have to spend time watching it. It's like 2 points in the day where I've got to do something, and it generally involves one stop. So that's pretty good. All right. So questions, comments, observations? Um,
Could you talk through, I think you were going to mention stop losses. Could you talk through that
yeah.
process a little bit?
So,
Candace had a thought on or a question on that.
Well, it's yeah. So there's, Candace, my feelings about stop losses, that sometimes you have to have them. And do I use them? Yes. I don't like them. I mentioned this because it's a tell. I mean, your order is there. I've had this long running debate with people like Doug Sifu, who will say, "Oh no, we can't see those," and I will say, "Well, in a sense, you can. I mean, you've bought the order." It's wow, that's a lot. Okay, so you're more than me, that at least in that portfolio. But as a general, yeah, I'm trading thousands of times. So yeah, I think that they're out there. They can get tripped. And I thought this article that I linked in a market desk note, and I think I have it here that I can share with you if I can get to it. Did I put that? Yeah, here. So this article, and it's in the market desk note, I think yesterday. And it's at Interactive Brokers by this Chris Longmore from Robot Wealth. I thought it was insightful. He said, unless your P&L is your signal, then you're taking a signal, your P&L, with no predictive power, and you're overriding the thing that you certainly hope has predictive power when you put in a stop loss, a stop and a limit. Because what you're saying is the price is your signal. And we always say, don't trade price, because the price is set by investment horizons of 400 milliseconds or less. So those prices are going to change all the time. And so if your predictive signal, which is what daily trading ideas are, we're saying that divergent demand and supply is a reliable predictive signal, keeping in mind broad sentiment and context. Earnings change that. Options expirations very predictably change the trajectory of market returns, but for a very short period of time. That is your predictive signal. So unless it's just to protect yourself because you of risk tolerance, they're not very useful. I'm generally not going to use them, but because I don't want somebody to trip it. But you have to be willing to take whatever risk is presented by volatility. That's why low volatility is less risky. If you're risk intolerant, you're better off with low volatility. If you're after returns and you don't mind the gut wrenches that come with it, I wonder if Eden's working on something. Then the better thing to do is I don't know why that's occurring. So I'm going to stop sharing. That what I was going to point out is volatility. So you have to have the stomach for volatility, and in the momentum portfolio, it's going to be at least 3%. And if you're concerned about that, then maybe low volatility is for you. But I really think that article hit it. That was it. It's an important point. Okay, what's next, Brian?
Sounds good. I was just listening and enjoying the conversation. I'll share my screen for a moment. I'll take us back to my favorite period. I'm joking, but 2020 seems to be hit whenever I go through this. So I I apologize because I go here every time, but it's been what's occurring in the market, and let me enlarge this. As we look ahead, to me, I just continue, Tim mentioned it already, continue to see a lot of comparisons between 2020 and this year. What I'm concerned about are, let's call it air pockets or turbulence. You can see it here. We talked about this a couple of weeks ago. That was a 7% decline. You can see it right through here. That was 10%. This was 7%. So all indicators to me, point to continued moves higher, but I think we will have these moves in the meantime. The problem is, we don't know when those are going to occur, right? And that's the issue. If we look at where we're at right now, we've seen this huge, basically triple sentiment top in the market. Huge move higher for short volume, those shorts starting to get covered a little bit. And to me, as we look ahead, and I already discussed it, but I'm watching big tech. If big tech continues to be strong, then I think the market's, to me, going to continue to move higher. But we are coming up on a lot of big tech earnings, so that will be something to keep an eye on.
Yeah, I will just add to that this is it's an aspect of that same data that is worth noting here. This is broad sentiment from April to present, and notice this, that the trend is down on the supply side, and demand. I mean, there's no entry point in the entire time, no break below the green line. So you have very strong demand. And generally a decline in supply, even though it's very high. I mean, it's 52% of the market. Again, function of the market runs on credit, just like the economy does. Everything's on a credit card. High short volume is a reflection of that. At some point, it will cost us. But you look at those things and say, well, that's the trend in the market at present. The one cautionary point, and it's why Brian and I both have some exposure to volatility, is because it's at levels that preceded sharp spikes before. Might not happen. I've thought, well, could we, if it's a compressed pandemic cycle, I've always thought there would be another leg. Well, it hasn't happened, has it? That's just my thinking, and I'm going to be wrong. I'm routinely wrong. But the data have not been wrong. The data have been spot on to tell us what we should do. And the market, it tells us it's been relentlessly up. And there are only two things that cause that to change. The credit card bill comes due, short volume has to be squared, or the gap, the spread in all the prices vanishes. And when that happens, things tend to break. Now, I don't know when that's going to happen. Might not be for a long time, but it could be. If this is a compressed pandemic cycle, then it's not going to run 18 months, but we'll see. Right now, here's what we know. The market is bottoming at 5. I mean, that's where it is, right? So, this does happen. If you backed up and looked at all the shallow bottoms, what happens when the market has a long period of shallow bottoms? It tends to precede a pullback. And we've had these shallow bottoms now for 3 straight cycles. So I don't know what's going to happen. If you expand the view out, you kind of see it. If you go look at, as I let the data, I had to refresh it, it's fine. You look at events like this, where there's there's a very you can go find those, and then what happens when there are shallow bottoms? That is, it's not doing this. You do this kind of thing, you get a lot of momentum. When the market bottoms right at neutral, you could go back over time, and it tends to be a signal that the market's going to have a pullback. Doesn't happen every time, but there's quite a correlation to that. So is that going to happen? Well, at some point. I'm concerned about the how compressed everything has been, that could happen, but clearly it hasn't, and there are many signals that would say we're in really good shape. And I'll finish where we sort of started, which is you look at the number and momentum and low volatility, they're good numbers. All right. Questions, comments, observations, words of wisdom? Barry Norton?
No, I've been to Sicily and to Tahoe, and so I've been on vacation. So I've been disconnected from the markets for about the past 6 weeks. So I'm just getting back into it.
Well, welcome back. How was it?
Sicily was great. I rode a factory Ducati all over Sicily for a week.
Oh, nice.
Yeah, 70
Nice.
of us toured all through Sicily for a week, so it was great.
Excellent.
I was
Excellent.
wondering, is it possible to get a portfolio of the S&P 500?
Well, I don't see why not. I mean, you mean put it in, have a S&P
Yes,
500 portfolio as a system portfolio?
yes.
Yeah, I mean, we license that data. So yeah, one would certainly think so. I'll I'll ask Joe or Eden to take care of that.
Perfect.
Yeah.
Thank you so much. Appreciate
Yeah.
it.
And I missed a question. There was something. Was Brad? What did you made some observation? Uh, there are ever more and more out there using options, mostly covered calls, to give yield on equities. Yes. Uh, well, they show up in a component. So the question is, how do those leveraged ETFs show up in the volumes? And yeah, I was listening to CNBC yesterday, and Rick Reeder, who's the kind of like the Brian Wilson of BlackRock. He's a bright guy. I like to hear what he has to say. He said BlackRock is writing a lot of calls, puts and calls against its portfolios to generate yield. Everybody's doing it. Goldman Sachs said today, boy, downside protection hasn't been this cheap since January. So they're encouraging people to buy it, right? So they're selling products. That's what they're doing. So we see that in what we call risk management. It's one of the four big behaviors. Now, it's not a perfect tool. What we do with the systems behind the scenes is we look for equity trades tied to counterparties for derivatives, and we can only get a statistical sample of it. But man, it's big. It's gone from about 16% of the market if you backed up pre-pandemic to 20% now. So it's at any given time, 20% of the market's capitalization rests on rights but not obligations. And in low volatility periods, people just want to collect some yield. And then all of a sudden that fails. And it's those things I think about. I do. It's part of my personality to be thinking about, well, what thing could go wrong? So the hard part is knowing when. But that we do try to account for it that way, Brad.